Hello, Scott Lushing with the Scott Lushing Mortgage Team here at Fairway Independent Mortgage Corporation. Just here today to educate you a bit on buy downs. There are two types, temporary and permanent. Permanent is when you pay discount points to get a lower rate for the life of your loan. For example, you could pay 2 points, save around 0.5%, and that 0.5% drop in rate will last for the entire life of the loan. Now, the savings are smaller than the drop from the temporary buy down, but it does last for the life of the loan. The only downside is if you end up refinancing, all those points that you paid are gone. When on a temporary buy down, you wouldn't lose it. So today, we're going to focus on the temporary buy down. Now, what happens is you get a 2% drop in rate for the first year of your mortgage. The second year, it drops 1%. From years 3 on, it becomes whatever your rate was. It costs around 2.15 points or 2.15% of your loan amount. It could be seller paid or buyer paid. And if you do sell or refinance in those 2 years, you get all that money back that's still left in that account. Now, this is pretty broad, so I'm going to get some specifics here. I want to use an example, but I also want to tell you that this didn't exist a few years ago because rates were so low. But with the payment shock and rates going up, we have a lot of people who aren't as comfortable with those payments. We have a lot of buyers that are still on the fence, thinking rates might come down or prices might come down. This helps you ease into your monthly payment. $450,000 loan at 5.75%. The total cost of this buy down would be right under $10,000. Now what happens? That money goes into an account and it subsidizes your payment for years 1 and 2. So year 1, you're actually paying 3.75% instead of 5.75. Your payment's $2,084 a month, and it's $542 less than what your payment would have been at 5.75. Year 2, your rate goes up 1%. You're now at 4.75. Principal and interest, $23.47. Your payment is still $279 less than what it's gonna be for years 3 through 30. And then it goes up to the regular payment at $26.26. How does this work? Well, we take all of this money here that's subsidizing it, and it goes into an escrow account. And every single month, we will apply that to your payment. So year 1, we're putting $542 toward your monthly payment. Year 2, we're putting $279. And from year 3 on, you're up to your regular rate with your regular payment. Now, a lot of people are going to say, well, why do I need to do this? Why can't I just manage that myself? Well, I'll tell you, a lot of people aren't that good at managing money, and a lot of people are budgeting. They're more comfortable seeing a payment that they can stomach each month. And that's why this is becoming a lot more popular. Who might benefit? People who get raises every year. You take a couple that's making $120,000 a year. If they get just a 3% annual raise each year, 2 years later, they're making another $7,308. That's $609 a month in additional income. So by the time that payment jumped to the regular payment in year 3, their income more than offset the difference. So again, they were comfortable in year 1 and 2. By year 3, they're already making more money. Now, it's also good when there's one earner out of work. For example, I have a couple where they're going to have a baby soon. The wife is not currently working, and she's probably going to stay home for at least a year or 2. They know that they're going to have more income once she goes back to work in the next 2 years. It's a great scenario. Another is when people are moving and only one earner has a job. So we're Florida. A lot of people are relocating here. We might have one spouse that already has a job here and another that doesn't, but they're going to wait till they're moved in and settled. So you have trailing income. So again, you want that lower payment in the beginning, knowing that you're going to have additional income coming later on. Now, one other thing which I don't want to get too in depth with is you might have some debts that are going to fall off in the next 2 years. You might have a car loan that in 18 months is going to be paid off. So for the next 18 months, you want to keep your payment low on the mortgage, but once your car payment goes away, you're okay with your mortgage going up to offset that. Finally, a new job where you might have things like commission and bonus. A lot of buyers, they have different forms of income, bonus, commission, and it fluctuates. If you started a new job, you might not be making money in commission and bonus right away, but in a couple of years you're going to be making a lot more. So that's kind of some of the scenarios in who might benefit. Now, who's going to pay this and why? I just gave you an example where it might cost $10,000. Sellers. I know it sounds crazy. Why would a seller pay for this? Well, if we were maybe 6 months ago, we wouldn't be talking about this, but the market is changing. Inventory is increasing, price drops are increasing. So, to your sellers out there, we know price reductions are coming. Why not offer a buy down instead? Hey, with the full price offer, seller will pay for a 2-1 buy down for the buyer and make the buyer more comfortable in their payment. It's the same as a seller credit. You can even include verbiage in the listing and make your property stand out. And you're going to attract more interest. So this is really more for my listing agents out there talking to their sellers. Now, if you're a buyer and you're considering paying discount points, maybe this is better. Instead of paying discount points, you could do the temporary buy down. And again, in 3 years, you might be making more income to offset the payment. Now, I want to give one more example. I have a lot of buyers that are putting 10, 15, 20% down or more. Well, instead of putting X percent down, maybe do 5% less and pay for the subsidy. So if you had a $500,000 buyer with 10% down, they're getting a loan amount of $450 at $575 in their payments, $26 a month. What if you switch to 5% down? You're actually borrowing more, but your payment is much less for year one. It's only $21.99, even with the $475 loan amount instead of $450. Year two, your principal and interest goes up to $24.77. It is still less than what it would be if you put 10% down and you're only putting 5%. Now, after that, it goes up to $27.71. So obviously, long term, it will be higher. But in this scenario, you actually put 5% less down. You paid the subsidy, so you're actually keeping almost 3% more out of pocket. You did 5% down, paid for the subsidy, and you kept about 2.85% more in your pocket. That's about $10,000 more that you kept in your pocket, and your payment is lower for year one and year two. By year three, you might have refinanced or your income went up, like I showed you in the other scenarios. Now, in full disclosure, there is a slight difference in PMI factors when you put 10% versus 5% down. So the savings here, the differences might be off by a little. But I want to share the concept with you. The concept of taking a 10% down buyer who's not that comfortable with the payment now, switching them to a 5% down buyer and having a lower monthly payment for the first 2 years. Again, this is all about easing into the payment and being comfortable. Oh, that is it. Inspection versus appraisal. That's for next time. All right, well, here's the thing. Reach out to me. Any questions you have, anytime. This isn't an easy concept to grasp, but if you're a listing agent, you need to be talking to your sellers about this and how they could promote their home and stand out by offering this. If you're a buyer's agent and you have some buyers on the fence or scared about the rates increasing, this is a good way to get them to ease into their monthly payment. And if you're a buyer and you're just looking at interest rate and it's killing you that rates went up, that's how the market works. But you can at least ease into that payment and be comfortable for the first 2 years, knowing by year three, your income's going to go up and you're going to be in a much better position to afford that payment long term. Call, text, email, send me smoke signals. Reach out with any questions. Thank you.